What's up, everybody? Ryan Pulis here from the Pulis Group with your real estate tax tips. We're a tax and accounting firm specializing in tax planning for real estate investors and small businesses. Today we're going to be talking about active participation and the $25,000 special allowance. Real estate activities are considered passive activities. Prior to 1986, investors were able to deduct all of the real estate losses against other income, which allowed high income earners to shelter income from their W-2 wages in active businesses by taking passive losses. In 1986, Congress enacted Section 469 of the Internal Revenue Code, which established the passive activity loss rules. Passive activity loss rules prevent taxpayers from using passive losses to reduce non-passive income, such as W-2 wages and active business income. Generally, passive losses can only reduce passive income. Losses in excess of passive income are suspended and carried forward to future tax years. Rental activities by default are considered passive activities, even when you materially participate. This is what's referred to as the per se rule. So what exactly is active participation? It's a special allowance of up to $25,000 for qualified taxpayers. Active participation is one of three exceptions to the per se passive activity rules for rental real estate. The first exception is real estate professional status. We've covered that in a prior video. The second exception from the per se rules is a complete disposition of your rental property or activity. When you sell your rental, you can deduct all current year and suspended passive losses for that activity. The third exception is active participation, which is the focus of our discussion today. The active participation exception is for taxpayers with a modified adjusted gross income of less than $150,000. You're able to deduct up to $25,000 against non-passive income. The full $25,000 allowance only applies to taxpayers with a modified adjusted gross income of less than $100,000 and is phased out 50 cents for each dollar over $100,000, completely phasing out at that 150K mark. Active participation is a less stringent standard than material participation. Only individuals can actively participate in rental activities. However, a decedent's estate is treated as actively participating if the decedent would have qualified. Let's take a look at an example. Here's an example of how the phase out works. As we mentioned, the full $25,000 allowance only applies when income's under 100K and then phases out 50 cents for each dollar over 100K until it's fully phased out at $150,000. So for example, if your income's $110,000, the phase out amount would be 5,000, 50 cents times $10,000 over 100K. Now your special allowance is $20,000 rather than $25,000. It's pretty simple. What is modified adjusted gross income? You've heard me say that now 5 or 6 times without defining it. So that's just your adjusted gross income calculated without certain items like taxable Social Security benefits, passive activity income or loss from Form 8582, rental losses due to material participation, and several other items listed here on the slide. You can find your AGI, the starting point for this calculation, on line 11 of your 2020 tax return. Now, how do you demonstrate active participation? You must own at least 10% of the rental and make management decisions or arrange for others to provide services. It's a pretty easy standard to meet. If you approve new tenants, approve expenses, or make similar decisions, you're considered actively participating. This can be true even if you're using a property management company. Your spouse's time counts towards active participation as well. However, note that the $25,000 allowance is not available if you're married, living with your spouse, and filing separate returns. You cannot actively participate as a limited partner. Let's take a look at another example. So in this example, we'll look at how the active participation works. Daniel LaRusso is the sole owner of a rental property, but does not materially participate because he uses contractors for repairs and maintenance, and they spend more time on the activity during the year than he does. Daniel does advertise the rental and he approves all new tenants in the lease terms. So in this case, Daniel actively participates and will be eligible for the special allowance as long as his income's within the limits. So to recap, active participation is one exception from the passive per se rules for rental real estate. You are allowed up to a $25,000 special allowance if your modified adjusted gross income is less than $100,000. When it exceeds $100,000, the special allowance is phased out 50 cents for each dollar, being fully phased out at $150,000 of modified adjusted gross income. You must have a 10% or more ownership interest in the property, and you must make management decisions or arrange for others to provide services. You are allowed to count your spouse's time, and you cannot qualify being a limited partner. This wraps up our discussion today for active participation. I hope this was helpful. Feel free to leave us a comment below in the comments section, or you can contact us through our webpage at thepulisgroup.com/contact. That's ThePulisGroup.com/contact. We're taking new clients and be happy to review your past returns for planning opportunities. Thank you and have a great day.